Apple isn't a stock, it's a business built for time. Most people look at Apple as a stock. Long term investors look at Apple as a business. That difference is why most people struggle with investing. If you want to understand money without the noise, how real businesses actually work, and make financial decisions you don't have to constantly second guess, well, this channel is for you. Like the video, subscribe, and share your thoughts in the comments because this isn't about chasing headlines. It's about thinking clearly over the long term. Question for the viewers checking out this video. Do you check stock prices daily or prefer investments that let you sleep? This isn't a recommendation to buy Apple. There are no price targets here, no predictions. Apple, ticker symbol AAPL, is part of the technology sector in the consumer electronics industry. Knowing these basics helps frame how we think about the company's business model without worrying about short-term price moves. This is an educational breakdown of how Apple works as a business and what it teaches us about long-term thinking. So, why is Apple misunderstood? Most people think about Apple and only picture iPhones. But Apple isn't really a phone company. It's a company built around habits, loyalty, and convenience. Apple doesn't need you to upgrade every year. It just needs you to stay. Once you're in the ecosystem, phone, watch, AirPods, iCloud, leaving becomes inconvenient. That's not marketing, that's design. And this matters especially for beginners because most people think investing is about predicting the future. In reality, it's about understanding behavior, your own and a customer's. Apple doesn't win by guessing trends. It wins by shaping habits. Apple makes money in two main ways. The first way is hardware. Phones, laptops, tablets, and wearables. The second way is services, such as subscriptions, storage, apps, payments. As a technology company, Apple operates across hardware, software, and services. This combination allows it to create recurring revenue streams, which is common in tech but executed exceptionally well here. The real strength isn't the products themselves. It's that Apple turns one-time buyers into long-term users. Recurring behavior creates recurring revenue, and recurring revenue creates stability, and stability compounds. Think about how often you replace a phone versus how often you cancel a subscription. One happens every few years. The other happens every month. Small, repeat decisions are what build durable businesses. Why Apple feels boring. Apple doesn't move like the stocks you hear shouted online or on TV. It doesn't promise overnight excitement, and that's exactly why many long-term investors respect it. Stability feels boring in a world addicted to speed. But boring businesses are often the ones that quietly build value over time. Excitement feels productive. Consistency actually is. Question 2. Which do you think matters more? Consistency in behavior or big wins from timing the market? Risks builds trust. No company is guaranteed. Apple faces real risks. regulation, competition, changing technology, and consumer behavior. It's also part of the S&P 500, so it's included in many portfolios. But inclusion doesn't remove risks. It respects it. Understanding a business means understanding both what could go right and what could go wrong. If you're new to investing, this is an important mindset shift. You're not trying to be right every week. You're trying to avoid being wrong in ways that compound against you. So understanding a business reduces emotional decisions, and emotion is where most long-term damage happens. Timing versus timing. Most people ask, is now a good time? A better question is this a good business to own over time? Checking prices every day doesn't improve results. It merely increases anxiety. Some investments demand constant attention. Others let time do the work. Question 3. Have you ever held an investment simply because it was predictable, not exciting? How did that work out for you? There's a reason people say good investments let you sleep. It's not about returns alone. It's about mental bandwidth. When you don't need to constantly monitor something, you are free. You free up energy for the rest of your life, for the rest of your day, and for the rest of that moment. Who is Apple and isn't? Apple isn't for traders looking for excitement. It isn't for people who need constant action. Apple fits people who value predictability, patience, and long-term thinking. That doesn't make it better or worse. It makes it specific. Question 4. Do you prefer exciting investments or ones that let you sleep and grow steadily? So here's the bigger lesson. The biggest lesson Apple teaches isn't about technology. It's about behavior. You see, most people don't struggle because they pick bad companies. They struggle because they can't sit still. They react. They react too often. They react. They check too much. They think. They overthink. Great businesses reward calm behavior. If this breakdown helped you slow down and think more clearly about investing, consider subscribing. This channel is for people who want to understand businesses, money, and mindset without rushing, reacting, or chasing constant opinions. The goal isn't to be busy, it's to be intentional.